Good morning and welcome to the Genus monthly webinar, Tax Strategies for 2023. My name is Thomas Irwin and I'm a partner and client relationship manager here at Genus Capital. And I'll be hosting today's session along with Jeff Borden, CPA and partner at OakTree Chartered Professional Accountants. Jeff has over 27 years experience in accounting, finance, and taxation, including small business management and ownership, corporate controller, financial planning and analysis, reporting, application, and leveraging information technology, real estate portfolio management, and payroll. Today with Jeff, we'll be taking a deeper dive into tax issues in 2023, including RSP versus tax-free account, and where should we make contributions, income splitting strategies, tax changes in 2023. Sorry, I'm just catching up to my agenda there. Tax treatment of investment income, CPP OAS, and when should I take them? We've left a good amount of time at the end of the session today for your tax questions, so I encourage you to please put your questions in the chat. You can do that anytime. We've also added links to connect Jeff with Jeff and myself on social media, and I encourage you to do that in the chat as well. Before we jump into the topic, let's take care of a few housekeeping items. You may want to maximize your screen. In the top right-hand corner, you'll see arrows, and that will enlarge your screen for the best viewing experience. And as I mentioned, just type your questions in the chat at any time during the presentation, and we'll spend some time later answering the questions. If you have any technical issues, and I myself just had a technical issue, you can let us know in the chat. We've got somebody standing by to help out. And one thing that we've found that works well is to just hop off the call, the session, and jump back in. And that usually takes care of any audio or visual troubles. I'd also like to start with a land acknowledgement. I'd like to extend my gratitude to the Indigenous peoples, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam nations, from whose lands I am honored to speak to you today. We do this to reaffirm our commitment and responsibility in improving relationships between nations and our own understanding of local Indigenous peoples and their cultures. Let's get started. I'd like to start today with a poll. So I'd like to just sort of gauge where you are at in terms of why you're here today. What of these 5 topics would you be most interested to learn more about? And we'll hopefully be able to use that in perhaps later on in the questions and try and focus in on that. So let's wait, give it a second, wait for some information to come in there. I'm actually not seeing a poll. Jeff, are you seeing a poll?
I'm not.
Oh,
either.
there it is.
There.
Just give it a second. So it looks like the 2023 tax changes, not surprisingly, is the #1 choice. Income splitting would be second. So that's good. Okay, so let's hop right in. We'll talk about RSPs and tax-free savings accounts. So here we have a quick comparison. Tax-free, what is tax-free? What is RSP? And we have on the RSP side, we've got tax deduction. So you're actually reducing your taxable income. Whereas with a tax-free account, you don't get the tax deduction. You're putting in after-tax dollars. We have deferred growth on the RSP side, growing tax deferred until the time it comes out, which is fully taxable. It's actually the least tax efficient account. On the tax-free savings account side, we have no tax on our growth. We also have no tax on our withdrawals, making it the most tax efficient account. And I've just highlighted the limits for 2023 at the bottom there. So 18% of earned income to a maximum of $30,780 on the RSP side, and the tax-free, the limit went up this year actually to $6,500 And if you've never contributed before, the lifetime limit is 88,000, assuming you have full eligibility. And Jeff, maybe you can just take a second there and explain to us what earned income is beyond simply salary income.
Yeah, so the earned income is income that you've basically done something to realize. That self-employment income, it's your salary from a job, and it actually includes rental income on privately owned properties as well. What's not included in earned income, so that does not generate additional RSP contribution room, is investment income of interest and dividends and capital gains. And there's a lot more little pieces that fall on either side of that, but those are the main categories.
Okay, so let's jump into a few strategies. And here the idea is we don't want to pay tax at high rates. So we want to make contributions in our higher income years and be drawing out in our lower income years. But the key part is here, we don't actually have to make the deduction, the full deduction, in the year we make the contribution. We can actually carry that forward indefinitely. And I actually recently helped a client by making a contribution to their tax-free, their RSP rather, right when they were about to convert to a RIF, because there was going to be a future sale of a property which would create capital gains. And so we wanted to have a little bit more room there to be able to offset that. And I think, Jeff, you had an example of a recent client who put money, a big chunk of money in their RSP.
Yeah, so client was 70 years old, sold the family home after husband had passed away, so had a lot of cash available and moved into a smaller home, downsized, all this excess cash and a big chunk of RSP contribution room available. So we topped it right up, used up all the contribution room in the last year that was available, but we did not claim the deduction all in that year. What we were able to do is, I think the total contribution was about 160,000, and we claimed about 20,000 of it per year for around 8 years. So even at age 77, 78, she was still getting a deduction for RSP contributions, reducing her income tax in that year, even though the money went into the account 8 years earlier. And meanwhile, that income is in a tax deferred account. So all of the income, there's no tax on that in the current year.
Right. Right. And the last part there is just RSP to RIF rollover. So at age 71, we're forced to collapse our RSP and move it into most likely a RIF. That can happen at any time, incidentally, but at 71, we're forced to do it. So there's a lot of tax planning opportunities before that happens and after it happens. Typically stop working and our income drops. And before age 71, when income can spike up again because we have now a RIF payment, which tends to be about 5.5% of whatever's there at age 71. We've got, that gap of years where we can take advantage of drawing some of that income out and paying less tax overall. So let's jump ahead. Tax-free savings accounts strategies. So here, ideally we would be able to put money into both plans, but if we had a choice of doing one or the other, we would want to focus here if we have a lower income year, because we're not getting the benefit of that higher tax deduction. And tax-free account contributions can actually be used in the future to fund your RSP and actually get the deduction in a future year where you have a higher income. On the withdrawal side, with no tax on the withdrawals, we have the ability to have a great tax planning tool here, especially for somebody who has a higher income. And any funds that are withdrawn, we actually create contribution room. So unlike an RSP, when we take money out of a tax-free savings account, we can put it back in, but not until January 1st of that next year. So I want to just highlight this slide. This is a great resource that I use quite a lot with clients when I'm looking at their RSP and how much should we be putting in and taking out. And this is off of the Ernst & Young website. And if you look at that sort of highlighted column, yellow column, rate on excess, that's simply the marginal tax rate. So if you look over on the left, there's the combined federal and provincial tax rates for British Columbia. And you can look at the marginal rate. And so the marginal rate is the rate of tax that you'll pay on that next dollar of income. And so we want to try and minimize that wherever possible. So if I just take a quick example, if your income was say 110,000, you'd be in that 38% marginal tax bracket. And so what would we want to contribute to get our taxes down, say into the 28% marginal tax bracket, save ourselves, upwards of 10% tax there. So we'd have to put $10,000 in to sort of get our income, $20,000 to get our income down to about 90. And this is really useful too when we're drawing from registered plans and we want to try and take advantage of the the graduated tax rates and drawing income out to a particular level and not incur a higher rate of tax. And we have the OAS clawback, which is this year, it's gone up to over $86,000. And at that point, we have an extra tax, an extra 15% tax, basically, where income over that threshold pays an extra 15 cents on the dollar in terms of a clawback. So we really want to keep our income below that wherever possible. And on the income splittings, this is a strategy where the higher deduction, the higher income spouse would reallocate income to the lower income spouse. And on the left-hand side, we've got passive strategies. So these are strategies where we don't have to really do anything. We would make an election on a tax return. So that can happen with a registered pension plan, also with RRSP income and some annuities. On the active side, so these are strategies where we would actually have to do something, open a different type of account, that kind of thing. Education plans, disability savings plans, these are plans that are government plans, and there's a grant that they provide. That grant and any income that's generated is taxable. So if you had a taxpayer and a high income making those contributions, they would be subject to tax. The beneficiary of the plans, typically they're not working or they have low income. We've now reallocated that income and any tax to those beneficiaries. The spousal RRSP is a plan where the higher income spouse would make a contribution to the lower income spouse's RRSP. It's their plan. The higher income spouse gets the deduction, and the funds, when they come out of the RRSP, would be taxed in the lower income spouse hands. Now, there are some little nuances there in terms of rules, but essentially that's a really good tax planning tool if you're going to retire before 65. At 65, RRSP income is considered pension income and it can be split. Spousal loan is another strategy, and that's one where the higher income spouse would essentially lend money to the lower income spouse. You can't just give it to them. There would be attribution, which is basically the tax would be attributable back to the higher income spouse. So to avoid that, we have to lend money at a prescribed interest rate. So we actually have to charge our spouse interest, and that level is about 4% now, I think, Jeff. Yeah, confirm.
That's right. The CRA establishes what the minimum interest rate is on that. It's called the prescribed interest rate, and those are available on CRA's website. They take the central bank rates over a period of time and do some calculations on it, and then they round up to the nearest 1%. So at the beginning of 2022, it was just at 1%, and because of the rapid rate increases, that interest that must be paid back to the lender of the money has now gone up to 4%, making these spousal loans or a loan to a family trust less efficient than they were previously, but they can still be functional.
And before we move on to your portion, anything else that you wanted to add? No. Okay.
No, I don't.
So let's move over to your portion and talk about the changes in tax for 2023.
Great. We definitely saw in the polls there that the tax changes this year was the biggest topic of interest, which is great. So I'll jump through some of those, and what you'll see in the tax changes for this year, again, with the high changes or high inflation over the last year and a half, the 2022, what's called the federal inflation factor was 2.4%. So it's based on the prior year. That's based on what the economy did in 2021. And for 2023, that index factor is now at 6.3%. So it's a significant increase. that affects all kinds of things. So it affects the tax bracket. So that's the amount of income before you jump to the next percentage of tax rate. The OAS benefits, CPP benefits, the OAS clawback threshold, the guaranteed income supplement, and other benefits and credits all across the area of tax are all being increased by that 6.3% this coming year. And the prescribed rates, I already touched on that, but those have gone up significantly as well. The major changes that come in that have been approved for 2023, you'll notice a theme here that it's all very much housing related. So the first is the tax-free home savings account. So this is to help people with saving up for their deposit for their first home. The contributions are limited to $8,000 a year or $40,000 lifetime. You must use the money in the account within 15 years of when you first open and make a contribution to the account. Income inside the account is not taxed. And when you withdraw the money from the plan, it's not taxed. So you put the money in, the investment grows, and that money goes directly into your home with no tax on it. So it's a great plan for that first home. And it may be a great way for parents to help their kids who are in university now or just about to graduate from university to start saving for that deposit for their first home. Or maybe you're planning on helping your kids with a deposit for their first home anyways in a few years. Open one of these plans, start putting the money in there in your kids' names, and it can accumulate without any income or any tax on the income that you would have earned in the meantime. And this can also be used in combination with the home buyer's plan from the normal RSP, which allows you to withdraw up to $35,000 from your normal RSP. So you can have that plus the money from the tax-free home savings account. That could add up to $70,000, $80,000, $90,000 towards a down payment. The home buyer plan, which has been around for many years, that does need to be repaid over a 15-year period. The next big change is residential property flipping. So this is a new one targeting speculation in real estate. So if somebody buys a house in Canada and sells it, or any home, house or condo, townhouse, if they buy it and sell it in less than 12 months, it's automatically deemed to be fully taxable income. So there's no access to the principal residence exemption, even if you lived in it. And there is no access to the capital gains tax treatment, where only half of the income would be taxable. They treat it as if you are in the business of buying and selling homes. So it's treated as fully taxable business income. There are some exemptions for special circumstances, which you will need to document and claim that exemption, such as a divorce, death in the family, bankruptcy, if your work relocates you across the country and you need to sell. So there are exemptions. I'm 100% certain CRA will review every single one of those sales that claims an exemption. So have your documents well in line ahead of time. There's also the housing taxes. So the new one this year is the Canada Underused Housing Tax, which took effect on January 1st. The first year of reporting for it is due April 30th. It's 1% of the assessed value where it's a non-resident, non-Canadian owner and the property is vacant or underused. So if they only use it for a month or two of the year, but it's vacant the rest of the time, that applies. And the BC speculation tax and City of Vancouver empty homes tax we've had for a few years now. They've both increased since they were first introduced. So now the BC speculation tax is up to 2%. City of Vancouver empty homes tax is increasing to 5% this year. So the potential for these taxes, which all compound, they could all apply to one property. So an empty house in Vancouver owned by a non-resident, for example, could be subject to up to 8% of the assessed value on an annual basis. So they're really putting some teeth on trying to stop, especially non-residents, from owning properties in Canada and just leaving them sitting empty. The next one is the home accessibility tax credit, which has been around for a while. So this is if you have somebody who qualifies for the disability tax credit living in your home and you make modifications to accommodate them. The change this year is that they've doubled the amount that you can expend. So it was previously $10,000, now it's up to $20,000. That's for things like safety bars in showers or a walk-in tub and stair lifts and wheelchair ramps, any of those sort of accessibility supports for disabled people. Brand new one this year is this multi-generational renovation tax credit. So this is if the in-laws are going to move into the basement of your house just for cost of living purposes, up to $50,000 deduction to build that secondary suite. It must be fully self-contained. There's various criteria that people occupying it must be related in certain ways, but it is a fairly significant deduction if you can take advantage of it. This is the marginal tax rates that Thomas had up earlier. I just wanted to touch on the different columns on the right-hand side. So the rate on excess, that's your fully taxable income, which is employment, it's rental income, it's interest income, and any foreign source income. The next three columns over from there, eligible dividends, would be dividends that you receive from, for example, publicly traded Canadian companies. So that's your banks and telecoms and such. Other dividends is generally going to be dividends from privately owned small businesses. So this is where people that were self-employed and have incorporated their businesses, their dividends would be taxed in this column. Capital gains, only 50% of the gain is taxable. So that column is exactly half of the first column of rate on excess. Lots of numbers on here. It can be a little messy to sort of understand, so we put it into graphical form here. So this is your fully taxable income. As your income goes up across the bottom, your tax rate goes up on the left-hand side. As you make more income, your tax rate gets higher. And then we expand on that. This is showing the light blue is the other dividends, so that's the dividends from private businesses. The light green line is eligible dividends, so from Canadian sources. And then capital gains is the dark line. And what you'll see there is that there's actually a crossover between the capital gains and the eligible dividends at around an income of 130 to 140,000. So the investment strategy, or an investor who makes 100,000 a year would probably prefer to receive eligible dividends versus capital gains because their tax rate is lower on that. Whereas somebody who makes 200,000, the opposite applies. They'd more likely prefer to receive capital gains because those are taxed lower for higher income taxpayers. And something to keep in mind is, why is there these different tax rates? It's all about incentivizing investments. So if you just invest in a GIC, does that contribute a lot to the economy? That becomes fully taxable income because the government provides an incentive for you to provide capital in the market for businesses to grow, which is buying stocks and equities. And that's why you get an additional credit on your taxes and pay a lower tax rate on the gains where you've taken more risk in order to create growth. So this chart is a comparison looking at a taxpayer with a salary of around 120,000 of how much tax they would pay on different types of income. So the first set of columns here would be on $5,000 of interest income. The orange columns are how much tax they would pay on that type of income, and the green is how much cash they would have left after tax. So as you can see, the interest income has the highest amount of tax and the lowest net cash after tax. Dividends is lower, significantly lower, and capital gains are just slightly below that. And if we compare the after-tax income from those investments, the dividends are about 36% higher than the same amount of interest income, and the capital gains are actually 39% higher. So I'm going to move back to the idea of income splitting. This is a pretty normal sort of example of somebody who has a fair salary during their working career. I've just leveled these off and ignored inflation for the illustration. So you have a salary while you're working for a bunch of years, that's the green bars. And then at age 65, you retire, you start collecting your CPP and OAS, which is the orange and yellow bars. And the horizontal dark green lines are where the different tax rates kick in. So we have a bunch of income that's being taxed at 31 to 38% while working. And then in retirement, you drop into this much, much, much lower tax rate. So the idea for income splitting using an RSP is that you want to take some income out of your high earning years and move it into your low tax rate retirement years. And that's what this shows here, is that the blue sections is where you've made it RSP contributions and reduced your taxable income in your working years, where you're paying 38% on that income. And instead, you're shifting that income into your retirement years. And instead, when it comes out of your RSP plan, the same amount of income coming out, you pay only 20%. So who doesn't like to make an 18% return just from the tax math?
Absolutely.
Just jumping back to that. The other issue here is that not only are you reducing your tax from 38 to 20% on this, but you're also deferring payments. So if you take the first year of that contribution, you're deferring the tax by likely 20, 25 years before you have to pay it. So you're also paying it with future money and time value of money. It's less expensive for you to do that. The next illustration of income splitting is using a family trust. So here, if we take a taxpayer who I've looked at a 10-year span here of a salary of 120,000, and then if they have another 50,000 a year of investment income on top of that. So the investment income is all in those very, very high tax brackets. And the concept here, unlike the RSP, which shifts your taxable income across time, so it takes it from the year you're working into a year of retirement. What this does is it takes the income. A family trust strategy can take that taxable investment income off of the high income individual and spread it across multiple family members who are in lower tax rates in the same year. And that's where you get a chart that looks like this. So we've taken the investment income off of the top of the high rate taxpayer and moved it to the spouse and the kids, and had the investment income taxed in their hands at a much, much lower rate. So looking at a plan like this of about 50,000 in income, we can shift probably about 40,000 of that income to the lower income tax rate family members. That income for the salary earner would probably have an average tax rate. It depends on the mix of investments and types of income, but probably an average tax rate of around 25%. And given the right family structure and beneficiaries of the family trust, we may be able to get that tax down to zero with a potential tax savings of around $10,000 per year. Family trust is a separate legal entity, so it needs to be you need to have a lawyer involved and an accountant involved. You've got annual maintenance and reporting fees, so there is some cost to it. It makes sense once you have a certain amount of investment income and eligible beneficiaries that you can allocate that income to. But a very, very powerful strategy if you can take advantage of it. One of the common questions that we get a lot is, when should I take my CPP? So the different options, if your CPP contributions have been maxed out for enough years, at age 60 right now, you'd get just over 10,000 per year. If you wait until age 65, it increases to about 15,006, and at age 70 is about 25,800 per year. And those are the three lines on the graph there. They start at age 60, 65, and 70. And if you wait, then your annual or your monthly CPP benefits will be a little bit higher. So if you're asking this question, it instantly tells me that you don't need the $10,000 a year from CPP at age 60 if you're willing to wait for it at age 70. So what if we say, okay, let's take, I got ahead of myself a little bit. I'm going to move to this slide. So the line's on an angle here, starting at the same point in time. This is the amount of lifetime CPP payments you would receive. So as you can see, the dotted arrow going down to about age 76, a little over 76, is where you have a break-even point between waiting until you're 70 or taking CPP early at age 60. So that's where at or somewhere around age 76, 76 and a half, you will have received the same total dollar amount of payments. And then the lines diverge again after that. So the question that I like to look at is, if you don't need that extra 10,000 in income at age 60, what happens if you take that, if you elect to take the CPP early and invest it until you reach 70, and then start drawing from the investment portfolio. So if you do that, this is roughly what the value of the portfolio would look like. So that orange line, you would grow that portfolio until you reach 70, and then you would start drawing from it so that your cash combined from the draws from the portfolio and the actual cash CPP payments you're receiving at age 70 would be the same as if you had just waited until you were 70 to start taking the CPP. What this does is it pushes your break-even point out to around age 84. So your total income between CPP and the investments breaks even between this plan and between just taking the CPP at age 70 out to around age 84. The other advantage that I really like about a strategy like this is that anywhere the orange line is above the gray line, that's additional cash that belongs to you and is in your estate should something happen to you and you stop collecting that CPP. So if somebody passes away, if they're anywhere if they're at, say, age 70 here, the portfolio would be somewhere over $100,000, and that's cash that's available to be taken out at any time, and it could be used for emergency or anything. So a good example, we've seen clients who, at 70, they get diagnosed with cancer, and their doctors say, it's bad, you have 6 months or a year to live. And they say, okay, we have this money in this account. While I'm still able, I want to take the whole family on a month-long cruise through the Caribbean. And there's that money available to do that, which would not have been there if you had just waited until you were 70. The last strategy, which is a little more aggressive, is what if you took the CPP at, the intermediate strategy. So this one is same strategy, put the investments in, but when you reach age 70, take a little bit less cash. So if we take $500 less per month than fully matching what the CPP at age 70 would be. And so it's just a little bit less cash, but what it does is it makes that investment portfolio last a whole lot longer. So as we can see here, it's still up around 120,000 additional portfolio at age 90. So if you don't need that extra cash flow, you can leave the money in. A nice thing about a strategy like this is when the money is in a portfolio, you can defer the cash draws, or if you have a major expense come up, you can take the additional cash at any time that you like. And it's not in an account where when you take a draw, it's taxable. The income in the portfolio would be taxable, but anytime you withdraw cash, it's just a bank withdrawal. There's no additional tax to worry about. And the last and most aggressive strategy with that is, what if we take that CPP, the $10,000 a year at age 60, and allow that to use that to make the mortgage payments and take a new mortgage, which right now would get you about $150,000 mortgage, and invest that. So you instantly start at age 60 with an additional $150,000 portfolio. CPP payments, monthly payments, are paying the mortgage payments. So there's no change in your pocket on a monthly basis. And that portfolio continues to grow. We reach somewhere around $250,000 or more at around age 70. And then you start drawing a little bit from it. Around age 85 or so, the mortgage payments are fully paid off, and then the portfolio actually starts to grow again. So this is a great way to provide significant increase to your estate that will go to your beneficiaries. And that is generally all I
Great.
have.
Thank you, Jeff. Important to note there too, anytime you're considering a leveraging strategy, it is enhancing your risk. Go make sure you talk to your tax advisor, your investment advisor before you do anything like that. But that was really good. Thank you so much. So let's jump into the Q&A portion of our presentation. And I've seen some questions already come in, so thank you very much. Please continue to put them in the chat. And Jeff, let me start out by asking you a question. You alluded to this a little bit, but what are some other common questions that you get that our viewers might want to hear from?
Sure. Probably one of the most common and most frustrating questions that I get from clients is they call and say, I have a lot of small business owners as clients, and so they'll call and say, hey, last month we sold this investment property, or we sold this business. What can we do to minimize the tax on that? Well, the opportunity for tax planning is before you've completed the sale, not after. Once you've done it, it's done. There's not much we can do, but often there's things that we can do on a structural basis in planning, in anticipating that transaction to make sure that we execute it in the most tax efficient way.
Right. Thank you. And a question came in from Letitia, and she asked, what is the disability savings plan and is it available in Ontario? I think I can take that one, Jeff. The disability savings plan is a government plan that if a beneficiary qualifies for the disability tax credit, then they would be eligible to receive grants from the government, which are based on income, but can range from 100, 200, even 300% of a contribution. And that plan can exist for, you can make contributions up till the age of 50 for the beneficiary. And then there's sort of a 10-year gap before payouts would start. So withdrawals would happen at age 60. And yes, it's available in Ontario. Jeff, anything you want to add about the disability plan?
Yeah, just that they're not provincial. It is a federal program, similar to RRSP, so they're available nationwide.
Okay, thank you. Ron asks, I believe I heard you say that OAS clawback now starts at 86,000 earned income. Did I hear that correctly?
It is 86 and change. I will.
It's 86,912 OAS clawback. And thank you, Sandy. Sandy in the chat answered another question. About the threshold. So 15 cents on every dollar on income above that threshold. And
yeah, it's like an extra 15% tax from that amount at 86 up until around 138 or so, and then all of your OAS is gone.
Yeah, I mean the question was specifically on earned income, but this would be on any income, right? Yeah.
Yes.
Susan asks, what if you contribute to the home buyer's plan on behalf of your child and the child does not use it due to changes in his or her circumstances? Example, he lives abroad.
Yeah, so if you collapse the plan without buying a home, then what happens is all of the investment income is brought into taxable income. So if you had maximized that plan and contributed 40,000 and it's grown to say 55,000, when you collapse that plan, the 40,000 comes out as a return of contribution. The income portion of 15,000 would be taxable, and that would be to the quote owner of the plan, which would be your son who moved abroad.
Great.
So even if he's not living in Canada, if he's non-resident at the time the plan has collapsed, there would be non-resident withholding tax at source.
Right.
Yeah.
Liz asks, income splitting is not available to single people. Are there any tax reducing strategies that work to the benefit of single people?
There are, and it kind of depends on what you do and what income sources that you have, and that's where most of the more advanced strategies for tax really come in. So when people are self-employed, we have a lot more flexibility than somebody who works for somebody else, just an employee that receives a T4. And generally that's for somebody who is self-employed, we look at incorporating, and then technically you are splitting income between yourself and the corporation, which can be very, very efficient for people who are self-employed. Somebody who is single and has a job, your options are a lot more limited. It's that RRSP contributions, which defers that income into retirement, or a year off. We have a lot of clients too that they'll take maternity and they'll take a draw. They'll take 20 or 30 or 40,000 out of their RRSP in that year that they're not working, that when they have very little other income. So that's a kind of strategy that we can take advantage of a bit there. Realistically, there's not a whole lot for single people other than just making sure you claim all of the credits that you're eligible for. I wouldn't, just because there is a credit for something, I wouldn't necessarily run out and spend the money in order to trigger the credit. Yeah, like I wouldn't go and spend $7,000 on braces because you get $1,000 tax credit for it. You get braces for other reasons. It's not a strategy. There's certain credits and deductions available to you.
Madeline asks, what tax rate have you considered on the CPP at age 60 before you can invest it?
Yeah, that's a great question, and it's not. I didn't factor any tax into that calculation, so often it depends. Do you have RSP contribution room, for example? Because if you can take that CPP payment that you weren't receiving before and you have lots of RSP contribution room, you can take the CPP, contribute it directly to your RSP, so there's no tax on the money coming in. So the full amount ends up in your RSP account and then grows, and then you will pay some tax on that income when you're taking it out of the account after age 71. But there's just far too many scenarios. Or you could take the income, take the CPP, contribute it to a spousal RSP, and then it's taxed in your spouse's hand when the income comes out 10 years later. So there's lots of different variables there, and it really depends on the individual situation.
I just want to highlight again, the CPP normal retirement age is 65, so that's when you would take it normally. The CRA allows you to take it as early as age 60. You'll get less if you do so. Your slides indicated that in terms of a percentage. I think it was 7.2% less a year if you take it early, 8.4% more if you take it later.
I forget exactly when they did that, but CRA made that, or Treasury Board made that change somewhere in the last 10 years, I think it was, where you could defer CPP past age 65. And they wanted to incentivize people to do that. So they offered that higher rate, an additional 8.4% a year if you wait to take it later. So one of the problems was that CPP was drastically underfunded at the time. They've resolved that by radically increasing the contribution rates. But effectively, by offering you 8.2% extra each additional year, that's your government betting you're going to die before they pay you as much. So they're saying every year you'll cost us, their calculations are you'll cost us 8.6% less. So we'll offer you 8.4 and we'll try and scoop that little difference.
Interesting. I can't hide my smile. Michael, did you take into account indexing of the CPP in your projections?
Yes, if I go back to this slide here, you'll see that these lines do gradually increase. So the indexing that I've used is sort of a long-term historical average of 1.75% is all that I've factored in there.
Brian asks, how much of what you said would differ for U.S. citizens? Loaded question.
I'm guessing that's referring to U.S. citizens who are resident in Canada. So all on your Canadian tax return, all of this applies. As a U.S. citizen, you are also subject to U.S. tax on all of your worldwide income. So it gets more complicated. And there's some items are protected by the tax treaty between the two countries, some not perfectly offset. So you may still have U.S. tax implications on the additional amount.
Great, thank you. Mark asks, in Jeff's last CPP investment example, is the interest tax deductible? Good question.
Yes, it absolutely is. Anytime that you borrow to generate investment income, as long as that investment income is in a taxable account, then the interest is tax deductible. So if you did the mortgage, one option is, if we jump to that here, you could take a mortgage, contribute this $150,000 to start off that account directly to an RSP and take a big tax deduction. So maybe you're working until age 62 or 63. You've got 3 more years of a high salary, and you could say, okay, this gives me a $50,000 deduction for the next 3 years, which radically reduces your tax, which is great. When you do that, contribute it to a tax deferred account, then the interest on the mortgage would not be deductible. However, you can use the tax savings from that RSP contribution to repay a big chunk of the mortgage, drive it down. It may be more cost effective for you to actually do that rather than worry about the fact the interest is not deductible.
And I guess another strategy along those same lines, and I haven't heard it talked about much, is the Smith maneuver. Do you want to talk about that?
Yes, absolutely, which is a great strategy. And this would actually be a strategy available for single people as well, jumping back to that earlier question. So a Smith maneuver is where you convert interest. Say, for example, you bought a condo and you have a mortgage for $200,000. The interest on that mortgage is not tax deductible because it was used to purchase your principal residence, which is a non-taxable asset. What a Smith maneuver does is there's sort of 2 ways of implementing it. One is in one big instant transaction, or you can grind away at it over a number of years. So the sort of classic Smith maneuver, it converts that interest expense into a tax deductible interest expense. And the way that works is you pay down some of your mortgage, and then you borrow from a line of credit and invest. And you do this on a monthly basis. So every month it might convert an extra, if you're putting $500 a month into your investment account, what you do instead is pay down an extra $500 of your mortgage, then borrow $500 more, and then contribute that to your investment account. And now on the new $500,000 of debt, the interest is deductible, while at the same time you've paid down the principal on the non-deductible debt by $500. And you do that over a period of time, and eventually the entire mortgage is tax deductible.
Right. But with current higher interest rates, that may not be a viable solution right now.
Well, actually, there's more incentive to do it now than ever because the interest rates are higher. The higher the interest rate, the more incentive there is to make that interest tax deductible. So when I talk about doing that as an instantaneous sort of transaction, we'll see this with people who have owned their homes longer and have built up an investment portfolio. So maybe they call you and they say, "Hey, Thomas, what do I do? I've got $300,000 left on my mortgage, and my banker's telling me that my payments are almost going to double when my renewal comes up now." And you have cash in the investment account or liquid securities. So what you could do if that mortgage is coming up for renewal is you could liquidate some of the securities enough, pay out the entire mortgage, and then you just take a brand new mortgage for exactly the same amount and put it back in the investment account. As long as it's out for a day or two, you've paid off that mortgage. Now the new mortgage is fully tax deductible, and that can make a radical difference. Your investment portfolio stays exactly the same. Your total debt stays exactly the same. But if you're now paying 5 or 6% interest on a $300,000 mortgage, that's an extra $18,000, $20,000 tax deduction every single year going forward.
Excellent, thank you. Here's a good question from Morris. The interest rate on a spousal loan does not change through the lifetime of the loan?
That is correct, yes. So if you initiated a new loan to a spouse or loan to a family trust today, the interest rate would be a minimum of 4%. And that's in place. That might be for 30 years. It's just an open term. It can be repaid at any time. And the interest must actually be paid by January 31st of every year following the year that the interest is for. So like 2022's interest needed to be paid at the end of last month. That loan agreement is at 4%. So if the rates continue to go up, then you're locked in at 4%. Even if CRA's rate goes to 10, you're still at 4%. You're locked in at that rate. If CRA's prescribed rate drops back down, we often see clients that have these type of structures in place because what that interest is doing is it's creating more income back to the lender, which we don't really want if we don't have to. So if CRA's rate drops back down to 3%, I'm going to be on the phone to all my clients who have these loans in place, say, write a new loan agreement. And essentially the new loan pays off the old loan, and now you have a loan that's at 3% that's locked in for long term.
Right. Bruce and Marion ask, what happens if you have an RESP, education savings plan, for your grandchild and he or she doesn't take further education after high school? And I don't
Then
Sorry, you go ahead.
You collapse the plan, and I think it's the grant portion gets returned to the federal government, and any income that's accumulated in the account is brought into taxable income for whoever established the account. Now, yeah, so it happens. We do see it. It's not ideal. You can set up a family RESP account that can have multiple beneficiaries of it. So you have one plan with all the kids. One kid doesn't go, not a big deal. Just more of the money goes to the other.
I was
kids.
going to mention that, so thank you for doing that.
Yeah, I mean, the actual money that you contributed to the plan comes back as a return of contributions, tax-free.
In any case, that money is never taxable again. Yeah. Allison
That's
asks, if my young adult children are very low income, but they are hoping or planning to buy a home, are they better to contribute to the home buyers plan than a tax-free savings account or RSP, assuming they cannot do everything? So one or the other. And if I want to help them, is that the one I should choose? So I think here, are they better to put money in a home buyer's plan within the tax-free savings account, that portion of it, or within the RSP home buyer plan? So I'm imagining that if they're low income, they're better to take advantage of the tax-free account initially.
I think so. I think I agree with you there, because the tax-free savings account has the most flexibility. So if they're not using the limit and not expecting to be able to use the limit in the foreseeable future, then the tax-free home savings account, or sorry, the tax-free savings account, not the new dedicated home one, has the most flexibility, because you can contribute up to your lifetime limit immediately. It's not capped at $8,000 per year. You can take the money out for any purpose. So if they end up not buying a home, there's no consequence of that. The money is just in that account and can continue to grow there. They can use it for a car or whatever. Whereas the tax-free home savings account is very specific to a purchase of real estate. So once the money is in that account, it must be used for real estate. Otherwise, you have tax consequence of taking it out later. So if they have lots of room in their TFSA first, I would say put it there. The nice thing with the RSP accounts as well is because you do have the home buyers plan, and you do get the tax deduction. So if they're low income, the tax deduction may not be worth very much to them. Or if they have a higher income, if their tax rate is going to be over 30% or so, it may be worthwhile contributing some to the RSP and taking it out under the home buyers plan instead. That said, the home buyers plan does need to be contributed back. It's not the year you purchase the home and then you have 1 year after that where there's no repayment. So in your second full year of ownership is when you have to start repaying 1/15 of the home buyer plan amount every year. So you can stockpile some cash in the TFSA, and then at least 90 days before making a purchase, you can transfer it to the RSP to trigger the tax receipt to get a tax deduction, and then draw it from the home buyer's plan out of your RSP as long as the cash has been in the RSP account for at least 90 days. So we've had some clients do that as well, where they're like, I don't have enough in my RSP. We've been saving cash here. So we transferred it to the RSP, got them like a $20,000 tax deduction from the RSP contribution, and then took all the money right back out. So now with the tax combined with their tax refund, instead of the $35,000 they could take from their RSP, they have $45,000. So it helped with their down payment a little bit more to repay later.
Okay.
It's a very personalized situation, though. Those kind of decisions really depend on what other assets do you have, what income sources, all of these.
And our final question, is it more tax efficient to invest through my corporation or personally over the next 12 to 15 years? If through my corporation, can I defer taxes on growth and draw money out more tax efficiently in retirement? We've got only a minute or two.
Sure. The short answer there is maybe. And the reason is that if you have an active business where you're generating profits and paying that small business corporate tax rate of just 11% and investing those profits, then yes, it's definitely more efficient to invest those profits inside the corporation. It is not less efficient to take money that you own personally right now and put it into a corporation and then invest it there. Corporations generally pay a little bit higher average tax rate than you would individually, but the advantage of using those small business profits as the seed money for that investment is that you have not paid personal tax on them in the first place, so you have more equity to start with. So the additional capital that you're starting with overcomes the little bit additional tax that is likely to result. Also, when you own your own business and that's where you generate your income, you're likely drawing dividends through the corporation anyways, which is triggering the refund of a lot of what's called corporate refundable dividend tax inside your corporation that holds the investment. So as long as you're taking some dividends out, which may have been your normal cash flow from your operating business anyways, then investing in the corporation can be extremely efficient.
Thank you very much. We could do a whole webinar on corporate tax, I'm sure. That's all the time we have for today. I hope Jeff and I were able to give you a few new strategies to consider and ways to save some tax. I know there's questions in the chat that we didn't get to, and if we didn't get to your question, we'll do our best to have that question answered directly by one of our team, as long as you've provided your name. Please stick around for a few moments as we close this session. You'll be redirected to a survey, and we'd love to have your thoughts and feedback. I want to express our gratitude to all of you for taking the time to attend our webinar. Both to our valued clients, thank you for your trust in business, and to those of you new to Genus, thank you for considering us. A big thank you to our speaker, Jeff Borden, for taking the time out of your schedule to be here with us today. In appreciation, Genus has made a donation to the SPCA on your behalf. I'd also like to thank the team here at Genus who work behind the scenes to produce these webinars. Join us for next month's webinar, Women in Impact Investing, where we will explore the ways women continue to lead investable and impact investing and cover key contributions that women are making today as members of the industry, as innovators and advocates, and as investors themselves. We'll also look at what possibilities are for tomorrow. Joining us will be a group of amazing industry experts, including our own Mary Lou Miles and Sue Talbot, Elise Crouston from Active Impact, and Mari Matthews from Spring Activator. You can sign up for that webinar using the link in the chat. And finally, a recording of today's webinar will be provided to you via email and will also appear on our website in the next few days if you wish to revisit any part of the presentation or share it with friends and family. Thank you again for joining us, and enjoy the rest of your day.
Thank you.